All right. So tonight we're going to talk about some insurance things. This will be the final lecture before the midterm exam. There's a separate video on that. Make sure you watch it. If you don't, you're not going to probably do very well on the test. So, I kind of throw you a bone here. Take advantage of it. And there's a couple questions that will come out of this part tonight. Again, for the exam. I mentioned this on the review that it's just done on Blackboard, right? This is not done through e-learning or RP Now. That's only for the final. So this one, when the window's open, and again, this is all spelled out in the other video. You'll take it. So it's not this week; it's the following week. But again, anyway, look at the syllabus. Look at primarily though the other video, and you'll know that stuff in pretty good detail. So we're going to talk about auto and homeowners insurance right now. What we're looking at is just the concept of insurance. This gets kind of controversial when we start talking about health insurance because health insurance is kind of weird because we have pre-existing conditions which are not really insurance. You know what I mean? They're a societal necessity, but to call them insurance is not really the definition of the term. And so I'm not trying to stir things up here, but for auto insurance or home insurance, if your house is burned down, you call up the insurance company, and go, hey, I've got a little problem here. I want to insure my home. They're going to go, wait a minute, you don't have a home anymore, or your car if it's pre-crashed. Yeah, that does not work. The way insurance works is that a commercial company, for all things except for flood insurance, a commercial company can have a pretty successful business model by providing insurance, by taking everybody's money, just a small amount, um, because they only need a small amount because not everybody is going to wreck their car in the same day. And so, yeah, granted, maybe small amounts kind of mischaracterization, whatever, a reasonable amount, or maybe that's not even right. But anyway, they're going to take some lesser amount than the whole charge, because they can make money based on the fact that not everything bad is going to happen to everybody on the same day. That's why flood insurance is not a private program. The only way you can get flood insurance is it's through the federal government. Now, it may be marketed, offered through your normal insurance company, but as you get in the process, they will be very clear that they are just the intermediary. They're just the processor, and the federal government's the one who's actually providing the flood insurance because, the government won't allow insurance companies, private insurance companies, to offer flood insurance because it'd be a scam. What they would do is they would take your money, and then the big flood happens, and they, declare bankruptcy and leave town because there's no way they have the resources to cover everybody at once. The principle of insurance is, again, that, not everybody is going to have bad luck on the same day. So that's the background on that. Now we're talking about property insurance, so auto and home. Also liability. So liability is what you do to other folks. There's not a legal requirement for you to protect your own stuff. If you want to trash your own car and not have any insurance, which is a completely reasonable thing to do if it's not a super valuable car, because the more insurance you have, the more money you're spending. So if you got an older car, you may not want to have collision insurance. Collision means that you did something, you were at fault here, and if you don't have collision insurance, your insurance is only gonna cover the other person's vehicle, and your own equipment and your own vehicle is not going to be fixed. So anyway, primary function to maintain your existing level of wealth. Yeah, but it's kind of hard to maintain wealth if you've got overwhelming insurance payments. So self-insurance, even, if you're a super wealthy person, there's probably not too many people, but there's usually a provision, like even for auto insurance, where they say, oh, you must have auto insurance. Most states will have a provision where you can post a bond and say, no, I'm got whatever 100 grand that I'm going to post in some sort of bond or pledge, to give me my level of protection and I'll be self-insured. So state of Alaska, that's how they do it. They don't have their own insurance. They've got, deep pockets, and rather than paying, some private insurer to take care of it, they'll just go self-insured. So that is an option. Managing risk. So when we talk about insurance, we talk about risk, we talk about perils. A lot of these insurance terms. So perils are the bad things that can happen, right? Fire, flood, whatever, hurricanes, stuff like that. We also will talk at some point about hazards. Hazards are things usually that a fire hazard, a shock hazard, something like that that is a sort of a defect. And if it's a known defect, if you say, leave a rake or have a toaster that's, sparking every day and you just sort of ignore it, well, if you let a dangerous condition exist, that's negligence. So not only are you liable, but now you're also negligent. And so if this, whole situation goes downhill, which it probably will, and you're not only liable, but you're also negligent, you caused, you got a swimming pool that's kind of a known attraction, maybe not that prevalent here in Alaska, but if you lower 48, you got a swimming pool without a fence around it, and something very bad happens with a child or whatever, oh boy, you are in serious trouble unless you had a fence around it because you had a hazard, you were negligent not to fence it off, and you know you got issues. So, how do you work around risk? Okay, so avoiding risk is what you don't do, right? Or it's very hard to do. Let's just say that. You could avoid risk by not driving, but then now you've got to walk and your lifestyle is going to be a bit impaired. You can reduce risk. You can do things to mitigate the risk. You can wear, safety belts. You can do other stuff. You can drive reasonably, not, have a bunch of cocktails and get on the road. There's things you can do to sort of manage that risk, and then also you can transfer it over to an insurance company to have them assume some of the risk. But what you don't want to do is ignore risk. The risk is going to be out there, but you have to manage it, right? So accept risk if it's low, or if you got the deep pockets and I consider a risk to have $1,000 a month insurance bill. So, a lot of times you'll sort of do whatever calculation. I had a vehicle one time that they have different categories of vehicles, and I guess there's 43 this one particular insurance company had, and the Viper I had was number 43. I mean, it had all kinds of power, no anti-lock brakes, no traction control, and whatever the demographic were people like me that whatever, I never crashed mine, but most of those folks did. So it was prohibitively expensive to have collision on it. If I crashed that vehicle, unless I wanted to spend upwards of about 10,000 a year, I was going to have to be uh, not be able to carry collision insurance. And so, I sucked it up and I never crashed the car. Good thing, but um, you know, if I didn't crash the car, I literally could have bought another Viper, within about 2 or 3 years of those insurance payments as high as they were. So you can compromise maybe in there. You could maybe have collision, but just have a high deductible, $1,000 deductible. The insurance companies love that because you don't bother them unless it costs $1,000, and so you file fewer claims and they can maybe help you with the premiums a little bit. But again, $1,000 is not that used to be a high number, but car repair costs are so high now that maybe even higher than that's available. I haven't gone there. I don't have collision on majority of my vehicles because I don't typically drive new ones, and um, you know anyway, it just doesn't make financial sense. Now if you have a new car and you've got a loan on it, oh yeah, they're probably going to insist that their asset, that car that you're driving, that they in essence own, that you're paying for, they're probably going to make it mandatory within the insurance that you have insurance on it. So that's what makes having a nice new car a little bit more expensive again. So insure against risk. The premium is the amount you pay. Um, you know that allows you to get that insurance. Economic impact. Again, they get into some of this macroeconomic stuff that, um, yeah, we're not going to go there. For the most part, these larger factors don't necessarily influence too many people's decisions. Types of insurance. So property, casualty. So they're looking again at the macro kind of sense. So property could be, automobile, stuff like that. Life insurance, we'll talk about that in another chapter. We'll talk about health insurance in a whole nother section because those get a little bit more complex. And they do have some, I don't think they're quite as straightforward as auto and property insurance are. So anyway, insurance company operations, insurance companies and premiums. So the premium is the amount they charge. The insurance companies can be arranged in different manners, and a lot of most insurance company the way they're organized, they're full service. In fact, if you have your auto and your home insurance with the same company, they generally uh, give a discount. So common events that could cause a financial loss. So these things can add up quite quickly, especially anything that has medical associated with it. I've dealt with a number of lawyers, especially up here, and oh my gosh, these guys just, they were interested in the type of things I was talking about because they were more business type ventures. They were just bored. They were personal injury guys, and they were making tremendous amounts of money, but it wasn't the most interesting work and not, very nice because they get a huge chunk of all these lawsuits and everything else that goes on. But I think you're pretty familiar with most insurance. We'll talk a little about life insurance and disability insurance. Disability insurance means you can't perform your job, and so you're disabled. Now there can be different forms. There can be kind that, say, hey, you're a roofer and you fell off the roof. Now you can't roof anymore, but we're not going to pay you because you can, sit at a desk and work on a computer. And then there's other types that say, well, you can't work in your chosen profession, so we're going to pay you on that. Obviously, there's going to be a disparity in cost. Long-term care insurance, yeah, if you end up in a some sort of assisted care facility, that is going to be excessive in terms of the amount of money required, but so is the insurance to cover it. So not a lot of good solutions here in the health and long-term care insurance, but we'll discuss them. Insurance agent. Yeah, a lot of times you're just getting this stuff online, but you could have a relationship with an agent. Um, some guys will, sell multiple lines. Other folks will represent a multitude of companies. Generally, you want to compare things, but you might be surprised that some of the most well-known companies out there are actually some of the more expensive ones. There's quite a range in rates, but some of these folks that have these huge advertising campaigns, and you see their commercials are ubiquitous. It's there's a price to be paid that needs to be passed on to the consumers. Auto insurance. So most of the times it's typically a requirement, right? Liability. So the government really doesn't care again about your own car, but what you do to other people. There's usually a legal liability for that, and the personal injury lawyers that I've talked about. Uh, no fault insurance sometimes helps in that, but the costs still continue to go up. Um, so you're familiar. I think pretty much everybody's familiar with what's in a what's in a policy, what's covered. We'll go through the numbers that are typically quoted, the minimum standards. Um, but again, you need to make sure that you are compliant with the law. But again, that just has to do with liability. Bodily injury, obviously the medical stuff, and then the property injury. Keep in mind, if you're somebody, I've had friends who have taken out a guardrail or something like that, that can be prohibitively expensive. So, it can be also if you hit some signs or take out some fence, that can get quite expensive. So here are the numbers the way they're typically quoted. So there'll be a series of these three numbers. And this is the way they work. The first part's a personal injury in an accident. The second number is all of it combined, and then the last one is the property damage. So, if you see that sort of number, um, keep in mind that there's a state minimum, but that may not be the desired one. And this might be where you might want to have, some advice from an agent because any of us can go, wait a minute, 50 grand for property damage? When I don't know. I'm not driving a $70,000 truck, but there's a lot of them on the road. I mean, I've already one other vehicle, and I'm already done. If I'm responsible for a multiple car accident, I'm going to exceed those numbers pretty quickly. So state law just provides minimums, and you'll see some of the states too. I think I've got a list of all the different states, and some states are just ridiculously low. They just haven't updated them. Medical care, passengers. So there's all sorts of weird situations. Getting back to the property, these I wouldn't call them ambulance chasers, but those guys, oh my gosh, I mean, they're talking about lady hits a moose. Well, who's responsible? Well, really it's the moose, right? But there's nobody to sue there, so the in this case, it was a passenger who got hurt. Um, does it make sense for the passenger to sue the driver? Well, she's the only one available to be sued, and so guess what? She does get sued, and she pays the whole bill. So it's it the law is going to look for who sort of has the deep pockets here, and the only one that's insured. I mean, the passenger obviously her insurance company wasn't involved here. The only available entity to be sued is the driver, so that's the one that's going to get sued. These are some of the different states, and you can see how they they're not exactly what you'd think. I mean, here's Pennsylvania with very low numbers. I mean, it's just sometimes they're updated. Alaska is actually definitely on the higher side, but again, looking at the numbers, the single, the combined, and then the property damage. I wouldn't consider 10 grand in property damage or 5 grand. That's we're not in the 50s anymore. Vehicles, everything else costs a lot more than that. Okay, uninsured, underinsured. So there are penalties out there. There are laws, but are there a lot of people on the road without insurance? Yes, and you'll probably find one of them. So coverage that takes care of that underinsured motorist, somebody got the minimums, or the people who are uninsured altogether. Collision and comprehensive. So I talked about collision, right? The cost of your car, where you're at fault. Now, if somebody else hits you and it's, they're at fault, your car should get fixed by that other person's insurance, and that's assuming they have insurance. But if they're liable, then your car should get fixed. But where collision kicks in is um, the policyholder, as in you, are at fault. Yeah, there's if you don't have collision, and again, when you're pricing out insurance, it will be obviously much cheaper if you don't have collision, but it'll be much more expensive, obviously, the total loss if you um, don't. So, again, I think I mentioned on the taxes where there's some provisions there in the tax. When you're doing if you're itemizing your deductions, and there's a category there for losses, and I've had to put a vehicle in there that was a total loss. I didn't get much money out of it, but it was tax deductible. The fact that I had a uninsured loss. Comprehensive, that's kind of the cats and dogs. All the other stuff, riots like that happens very often. But anyway, any of those things that happen, windshields, trees, stuff like that. That would fall under that situation. Um, so Comprehensive. Now, again, if you start reporting a lot of things, and you'll see this, especially, with us up here with windshields, if you report windshields over and over again, um, you may see your premiums start to go, and you may find, an affordable windshield place or a place that wants to, use some of that liquid to make it drivable or whatever. But anyway, keep in mind that there's nothing to prevent the insurance companies from raising your rates if based upon the more claims you file. Now, I'm not saying not to do it, but I'm just saying make sure you know talk to your agent if you actually have a person you can contact, and talk to them about the wisdom of reporting a damage, whether it's going to be worth it to you in the long run or whether you should just fix it. And if you're just going to fix it, then that would kind of argue for what I was talking about having a higher deductible. And so that's what a deductible is, right? You have $1,000 deductible. That means that you pay upfront $1,000 before the insurance company even touches it. So the insurance company knows that if you have, let's say it's something, it's got to be pretty minor actually, but let's say there's $1,200 worth of damage. Are you going to report that? Probably not. Not if you got $1,000 deductible, because the insurance company's only going to pay an extra $200, and it's probably going to, be reflected in your subsequent premium. So anyway, one way of adjusting your insurance rates is with the deductible, and if it's an older vehicle, by dropping the collision or keeping the collision. Also keep in mind too that if you've got this isn't any normal car, it may be a 1968 vehicle, but it's a Camaro and it's worth a ton of money. Well, not the insurance company, not necessarily, unless you have a special policy. They're just going to go, yeah, it's a 68 Chevy, it's worth $700. So if you do have some sort of classic vehicle or something nice, again, you're going to have to identify that in the policy, and probably not going to be able to get that insured through a normal insurance vendor. It's probably going to have to go through some sort of classic car, or you're not going to have the protection you think you got. You're going to be very disappointed if there's a loss. So other provisions, additional, yeah. So some things though that are can be kind of a no-brainer. Some of the roadside protection. I guess as you've probably surmised that I drive some, questionable, beaters with heaters, commuting back and forth, or old trucks and things like that. And roadside assistance is a nice thing to have. Very nice. I usually do not opt for the rental car that I would get if there is a accident. There's usually a provision in the insurance policy where they'll provide you a rental car in the event of an accident. Well, if you delete that, because in my case you have multiple vehicles and I'll just drive one of the other cars, you can avoid that. So you've got some things you can change around, but I've used the roadside assistance on a number of cases and it works pretty good. But anyway, it's up to you. Um, Other things, yeah, insurance fees, lawyer fees. So the summary, we talked about liability, we talked about collision, medical, bodily injury, and then comprehensive is kind of the catch-all. But insurance stuff can be kind of weird. It's not really an auto insurance, but let's say you have a tree in your yard that falls over and crushes your neighbor's shed. Who's at fault? It's God. That's an act of God. So a friend of mine, he had this occasion. Your neighbor's like, "Hey, your tree crushed my shed. You owe me." And my friend didn't get upset about it. He just said, "Oh, I mean, he didn't acknowledge blame or anything, but it's just like, yeah, you're silly if you think I'm paying for that. Go talk to a lawyer or whatever. I'm not going to fight about it. I'm just going to ignore it, because when you get upset here, you're not going to have a leg to stand on, because acts of God are part of the way insurance works as well. What happens with your premium? So, like I said, an expensive car, especially one, now where you've got, things where there's a lot of composites, a lot of plastics and stuff that is very hard to fix, or can be. And then, the characteristics of the car themselves. Certain cars get in more wrecks than others. and that's just the nature of the thing. There's an old Top Gear episode, not to bore you, but they had a 68 Charger. These things had horrendous brakes, and they were talking about, how often those cars got in wrecks because the braking system wasn't that good. But they also said that the good thing was that you're guaranteed to be at least, 20 feet from the scene of the accident because the hood is so long that you're going to be so far removed for it. But anyway, certain cars have better track records and cheaper repair costs than others. And then as as a typical student, you're the heart of the envelope, especially if you're a male. Your age and everything else is going to affect you. And if you're driving a sporty car, that's going to affect you. How many miles? And then they do some of these insidious things where they will, you can get devices to lower your rates, but then they monitor how fast you drive and how far you drive, and that gets kind of creepy. Also, your driving record. If you have accidents and tickets, uh, you know, as you already know this. Where you're located, driver's training, if you had some, school performance. I mean, we're talking younger folks here, but that can also be several different quotations, compare policies at renewal time. So again, it is like a bank, the kind of the bank situation. Are they still the most convenient? Are they still the cheapest? Are they, taking care of me when I've got an issue? Because you will find a fairly, high disparity in rates that are available to you. Insurance premium, so it's not always what you think. I mean, some of this may be the legal costs. I would think in Alaska it might be a bit less. Some of these states where you have a lot of lawyers kind of at the ready to jump on any sort of liability. Those are definitely going to increase the rates and the medical charges. Okay, so homeowners insurance. Um, just one second. Let me check something. So with homeowners insurance, it's fairly straightforward. It's usually a condition of the mortgage. Most people don't own their home outright, so typically it's paid as part of your mortgage payment. It's included in one of the escrow type things. That's money that's held back into an account, and the mortgage company pays that for you. They want to make sure that their assets, since they've got the loan on it, that their collateral is insured. So it's usually fairly reasonable, a little more straightforward than auto insurance. You do have typically some liability insurance, but if you're doing something, excessive or whatever, you may want to have more, or you've got, quite a bit of money, you may want to have more liability protection. Anyway, and then they were going to start talking about the perils. So, again, perils, fire, lightning, riots. I love that. Um, Different items, nuclear accidents, war. I mean, they're getting down into different things here. Uh, if you're in a renter's type situation, or say you're an owner of like in a condo situation, there's going to be different insurance products, right? If you're a condominium owner, well, you own the condominium basically from the paint inwards, right? You don't actually own the drywall or the walls. You own just the carpets and the other stuff. So the insurance is going to be cheaper because what their insurance is what they're insuring is less. If you're a renter, then all you own is the contents. So um, that's going to be a different product. And again, renters insurance, for example, is going to be usually quite affordable because they're really only insuring the contents, and the condo stuff is going to be a little bit cheaper as well because structural damage and things like that. That's well beyond what you are insuring. That doesn't mean that you're going to escape that. I mean, you're going to be contributing to the condominium owners association, the insurance that they're paying on those other things, but you directly paying it is smaller. Property damage. So this is what I was talking about in the. I think I mentioned this in the midterm review. If you watched it that way, if you're out of order, but there's different types of insurance policy coverage you can get for homeowners insurance. And typically, so you don't have any surprises, you would want replacement cost. Um, the other one is just going to be, well, what they're going to call it cash value. But anyway, it's just going to be a depreciated cost. So let's say, you know, big earthquake happens, the TV falls off the wall. It's $1,000 TV. If you have cash value, you're probably going to get about 200 bucks. If you have replacement, you're going to get maybe 11, 1200, whatever it costs for that new TV. Actually, it's going to be equivalent TV. So with technology, that same TV is probably a little cheaper. But in any case, you're going to get a a like TV for no money out of pocket. So keep in mind too that especially some of these, it was an extended warranty policy where I did have a TV fall off the wall and it crushed, and so I went in the store and I said, yeah, I'm going to get a new TV. My other one, they said, oh, you should have taken our extended warranty. It would have been covered. And I thought, yeah, maybe next time I'll do that. And then I got to thinking about it, and they gave me the little policy for the extended coverage. I called up the extended coverage people, and they said, "Oh, it fell off the wall. No, that's not normal wear and tear. We don't cover that." So, a lot of times the people selling the stuff don't even know really what they're selling, and 2 years down the road, you're not going to have that representative from the store. All you're going to have is the document that you signed when you got the extended warranty. So be careful what you're signing up for. So back to homeowners insurance, cash or replacement. Replacement's going to be a little bit more, but go figure. And especially if you have like fire or smoke damage, usually the smoke damage will, especially if it's clothes or something like that in a house, you'll be astounded how little they say your clothes are worth. Yet, if you have to go out and pay full price for them, you will probably be wishing you had the replacement. Um, Other structures on the property to a certain extent, if they're listed, personal property. And this is where I was talking about, again, I'm kind of mixing lectures here, but if you have some fancy, photography or guns or something like that, you need to have them specified and make sure the insurance company is signed up to cover those items, because usually there will be, some caveat in there. We'll cover, theft of jewelry up to a level of 500 bucks or something like that. And you may have, a single item that greatly exceeds that. So that would need to be specified in what they'd call a rider or a floater, right? And it's just a separate addendum that identifies those certain items to make sure that you have insurance for them. Personal property. Here they're using rider. I mean floater. I've also heard the term rider as well, but it's just an addendum to the contract. Liability. So we know what that is, right? Liability is harm to other folks that's assessed to be your fault. And like I say, my liability lawyer friends, they can find liability where you would not think it exists, but the courts will generally, find it. They'll agree with the lawyers because they want to make people whole. They want to find a way that they can pay them off. Other provisions. So yeah, additional living expenses, loss of use of provisions. So your house is destroyed in a fire. Are they going to put you up in a hotel? Why you cannot live in that home? Things like that. They're all available, but obviously a little bit more money. So what's going to affect the insurance premiums? So when you go to buy a home, if you've ever been in this process and you go get the insurance, they're going to ask you a whole litany of questions, and they're going to do a little research on their own, but they're going to want to know obviously how much the house is worth and the deductible. But this location question is going to be huge depending upon, they're going to want to know how far it is to the fire station, and they'll probably do that on their own. Do you have a cedar shake roof? Do you have some sort of composition roof? What kind of other material, or are they worried about earthquakes? Well, not if they're not insuring it. Now, it would be nice to know that you don't have any earthquake insurance, which is typically the case unless you specify otherwise. Degree of protection. and then discounts. These guys, but the discounts, this will, they'll start asking you questions about CO2 detectors and smoke detectors, and do you have, um, or other items like wood stoves. They don't seem to like those, obviously, because the fire hazard. So, um, kind of have your facts straight before you make that call because your premiums may be adjusted up or down depending upon how you answer those questions. So go figure. A few earthquakes, I mean not earthquakes, but tornadoes there, hurricanes, all kinds of stuff. You get what both hurricanes and other items happening. Idaho, you know, not as vulnerable. Certainly no hurricanes, probably no tornadoes, maybe lower cost to repair things. So it's going to depend upon different states. Again, Alaska, they don't have a rates specified. Strategies to reduce it. So a higher deductible, like everything else, have, you know, if they come out and they look at your house, sometimes they'll actually want to come out and take a look. And if you have, spruce trees leaning right up against the home, or you're, say you're in California and you don't have a clear fire break around it, you may be uninsurable. Um, One insurer, yeah, if you combine, I know I get a discount for having my auto and home with the same folks. They do like you to stay around, but again, don't be afraid to shop around, which is that final thing. Renter's insurance. I've seen this where the actual renter, the landlord, will insist upon you having it. I couldn't quite figure out the angle, but it's not that expensive, and I'm sure some of you have it now, and it's probably in the $100 $200 range depending on what you got. So it's worth having. Umbrella liability protection. So if you've got much in the way of assets and you want to protect it, um, sometimes you'll get a liability coverage, and you can get some pretty high numbers for not much money. $1 million policy is affordable, but that's only if you have big assets that you need to protect. So that's uh, that's the property insurance segment. We'll talk a little bit here about health. So this is something that's kind of interesting when especially as we're in a political time here with the elections and everything coming up, and people do or don't have health care or whatever. Um, when they talk about these changes, the Affordable Care Act or Obamacare, whatever you want to call it, we're not affecting everybody here. Most people have some sort of insurance that's subsidized by their employer. So that is why, changes like say a well, I don't even want to quote the plans, but if say they did some sort of Medicare for all thing and they got rid of the employer thing, now you're affecting a lot of folks. Um, Whereas making changes down here in the Affordable Care Act, you're not affecting a whole lot of folks. Medicare, so you got Medicare, Medicaid, sounds similar. Medicare, these are the older folks, right? Medicaid is, I don't know, it sounds a little pejorative, but the welfare crowd kind of thing, and Medicaid down here in the CHIP, the uh, infant and children kind of stuff. So that's a certain percentage, and then there's uninsured. Now this uninsured can be truly people that can't afford insurance, don't have insurance, or it could be a couple percent of this at least are people that are like, they're rolling in it and they're like, I'm self-insured. I don't, I'm not working for anybody. I'm, and they've, let's say the top 1% people, they may not and go to any of these insurance programs. They may just carry their own, um, self-insured. If they go to the hospital, they pay cash, and they can probably do so for a fairly reasonable rate. You see this a lot in Europe where they do have like mandatory insurance, but a lot of people don't like it. So you go to Eastern Europe and you see a lot of uh, dental type things. I've been to out in the the Baltics and Poland and places like that, and you'll see some medical tourism, and I think you have some of that in South America as well. I haven't traveled much down there, but people will go down there for medical procedures that are quite a bit less, and they'll just pay cash for it, and they'll have some minimal policy back at home. Anyway, different ways to work that. So insurance companies, private insurance, or the government offers healthcare expenses policy. So critical component of financial planning. So when we're talking about bankruptcies before, and bankruptcies are not always, people just being completely irresponsible with the money. Most bankruptcies are driven by medical situations. And let's face it too, with some of the premiums, especially under the Affordable Care Act, I mean, premiums of 7,500 a year or something. I mean, they're horrendous amounts where you're having insurance to prevent a catastrophe. And some of these cases, the premiums themselves are the catastrophe. So, more background. Um, 1 in 5 is uninsured. So there is a tendency, for fewer benefits, perhaps higher salaries, sometimes not, but less in the way of benefits. And anyway, hopefully there'll be some resolution to this in the future. But right now it's still kind of a mess. Um, Pre-existing conditions. This is where to call a pre-existing condition insurance is it's kind of a it doesn't really fit within the definition of insurance. So that's where some sort of government subsidy is a component of it because there's just no way that a commercial a profit company can insure people that have conditions that already exist. And again, going back to the automotive or the house type thing, if you don't go to the insurance company and say, yeah, I've already, I need to get insurance for my car, and they ask to see, you say, oh no, I've already crashed it. That does not work. So there needs to be another program that's not going to be a profit driven program because there is no profit when you get in the realm of pre-existing conditions. So I don't know why pregnancy's on the top. That's not a pre-existing condition. But dental insurance and vision, these are kind of straightforward. These are actually easy to talk about. Dental insurance and vision insurance are something you can typically get for not a whole lot of money. In fact, people are also, not that it's in healthcare, but people are also getting, vet care that doesn't really fall into other stuff, but for their pets. Determinants of unreimbursed medical expenses. So medical expenses, like I said, for IRS purposes, it's kind of ugly. They are deductible, but only over 10% of your income. So if you're making 100 grand a year, you have to be pretty sick because you have to have over $10,000 a year of unreimbursed medical expenses. That means you got no money from insurance. You just had $10,000 of expenses before you can even start deducting them. So, talked about deductibles, just like anything else, co-insurance. If you have, it's very difficult. I've had two insurance providers at the same time, and it's just horrendous. One doesn't want to pay until the other one is paid, and it just generates a huge storm of stuff. So I actually had a military, benefit, and I also had a private insurance company, and the two of them just could not play nice together, and so I had to get rid of the private insurance and go strictly with a enhanced, veterans kind of thing. So anyway, if you ever end up in that situation, you may have your spouse has one insurance and you have another, and they find out about each other, and they of course want the other company to pay before they pay. So um, it can be confusing. Covers limits and coordination of benefits. So there's a lot to healthcare. Expenses not covered by private insurance plans. They do have, medical savings accounts, flexible spending accounts. But again, I hate to be a downer here, but until this whole situation gets fixed, until there's enhanced private insurance or um, a better public option, things are going to continue to be a mess. And a lot of that goes back to the lawyer issue as well, because the expenses in the medical industry are quite high, and a component of that has to do with the coverage, the malpractice, and the liability. So it's not a good situation. So I referenced this before, Medicare, so older folks over 65. None of us are there yet, so I'm not going to go into great detail on it, but it's a fairly expensive, government program. Medigap, sometimes, little things, and if you watch bad TV, you'll probably see all sorts of things about, uh, small supplemental policies to take care of some of these gaps in the coverage. Medicare prescription, don't really care too much about it, but it's going to cover drugs for those folks. Now, Medicaid, this is, aged, blind, disabled, and needy. So again, more of a welfare type program, federal guidelines administered by the states. Affordable Care Act, it was sold as going to be the fix, and the problem with this is it doesn't really have a champion. The people who put it forward wanted to be transitional to something else, and that transition never really happened. And so it's never been an end in itself. It was this doesn't really please anybody right now. So that's why there's push for it to move to something else, anything else. Long-term care, so nursing homes, assisted living can get quite expensive. So, and a lot of times too, you'll see that if a person has any assets at all, they basically have to, you know, if say they're an older person, they need to go into a home, they're probably going to end up losing their existing home because they're going to quickly, burn through whatever savings they have, and then probably have to sell that home, and things can get quite ugly in a hurry. But it's, a situation hopefully very few of us will find ourselves in. But there is insurance that you can get, but it's if you start early, when you're younger. But if you wait till you're in your 50s and you try to sign up for this, it's going to be quite expensive. Long-term insurance, so age and your health condition. If you're already, there probably will be a physical associated with this, or at least, blood testing or some lifestyle questions. If you're a smoker, if you're older, if you have pre-existing, you may not even be able to get this. For me, if I was looking at a situation like this, I think this would be probably the time to leave Alaska because this type of thing, especially if you're not going to be out enjoying the great outdoors, to stay up here in a long-term facility, there aren't that many to be had, and they are going to be more expensive. So, disability insurance. So this has to do with you're, you know, not able to carry out your profession. You're generating an income and you're no longer able to do that. Now, there's different definitions on this. It'll be spelled out in the policy. So again, the example I used was a roofer. You fall off the roof, you can't roof anymore. Um, but you can sit behind a desk. Well, you can do any occupation, so we're not going to pay you. If your own occupation, my chosen job's a roofer, I can't do that anymore, and now you have to start paying me. So um, there's going to be different ways, you know, different parameters that have to be met before the insurance company is going to start paying. Individual disability, employer, and then also Social Security and workman's comp state program that employers have to pay into. So could either be a dollar amount or a percentage of your income. They're not going to typically pay 100% because you no longer need to commute to work. You should be able to live for a little less money now that you're not having to, be out of the home as much. But anyway, a lot of arbitrary things in there. And then with any or many insurance policies, there's a certain period, length of time before full benefits go into effect. And again, down in the fine print, renewability, the rest of all important questions that you need to look at. So it's typically in a disability situation, it's going to be a combination of things. There's going to be a government component that's been paid into, and then there's also an option for, more extensive coverage through a private option. That's it we've got all the material that's going to happen before the midterm exam. So to reiterate, 40 questions, multiple choice, 60-minute time limit. The thing just shuts down at 60 minutes. And what I was also talking about I was listening to the video I made for the review. It's not open book. So if you're, doing the exam on Blackboard on your computer and you're, Googling stuff, Blackboard more often than not will just shut down on you just because it's not that robust of a program. And so it's not open book. So don't, be doing that because you'll call me up and you'll say, oh, I was taking the exam and all of a sudden it just stopped. And make sure you've got obviously a charged battery, good internet connection, and watch the review video before you do it. And there's more info in the review video itself. So good luck on that. And that's it.